Steve is the branch manager here in Greeley for New American Funding, a local mortgage lender. Steve has been in the mortgage business for 45 years and has helped thousands of clients purchase a home. He enjoys working with first-time homebuyers and helping them on the path to home ownership. In addition to mortgage lending, Steve helps families develop a pathway to creating wealth for themselves through financial tips and strategies he has learned during his career. He is married to his wife, Megan, and has lived in Greeley for 30 years. He has 3 daughters who have graduated from District 6. He enjoys time playing golf, traveling, and spending time with his 6 grandchildren. So thank you, Steve, for joining us. And I'll put the sign-in sheet at the end of the session today for you all, as I think everyone's used to that by now. But I'll pass it over to you, Steve.
Well, thanks, Rachel. I appreciate it. Welcome, everybody. I'm happy to be a part of your group here today. I know we only have about 15 minutes here, but I thought I'd keep it a little bit short, especially it seems like a lot of you might be on your lunch hour. So we'll just keep it short. In addition to that, it's, many of the things that I talk about are personal, and sharing things over a Zoom call isn't the proper way to do it. So basically what I would encourage you to do is, if you find that some of the things I say are useful, or you'd like to talk to somebody at no cost, give me a call or shoot me an email. I'll give you that information at the end. Does anybody want to volunteer? Just kind of either tell me what they think most people are struggling with today financially. Nobody?
Okay, Steve, this is Lynn Decker.
Hey, Lynn Decker, neighbor.
I know. I would say probably just regular expenses. I mean, everything's going up and the interest rates are so high, so young people can't buy homes. And, you don't want to buy a new car because you don't want to pay the rates.
That's spot on, Lynn. It really is, and I didn't pay Lynn to say that. But as we all know, and we've read and heard on the radio and saw on TV, inflation has really hit us all. The last couple years with higher interest rates, as Lynn mentioned, higher cost of food, higher cost of gas, higher rates, on credit cards. Right now, credit card debt is at an all-time high, as well as student loan debt. And we're worried about that as folks that are involved in the financial services business, because is there going to be a bubble of debt that's going to come down the road? Foreclosures are not bad right now, but they are increasing a little bit. And so as we look at the national economy, we do see that the inflation is still high. It's not under the 2% that the Federal Reserve would like it to be. And so we are also kind of struggling with the inflation factor of things, and the easiest thing we can do, if possible, is to tighten our belts a little bit. And that's what I wanted to talk to you a little bit about today. It's important to take time right now, while it is an inflationary period, to get your financial house in order. So when things do get better, interest rates come down on credit card debts and on mortgage loans, we're in a better position to go ahead and address those issues. I would encourage you to either get in touch with myself or a trusted advisor that you may know already, that you've worked with in the past, to kind of sit down and take a look. My goal, as Rachel said in the beginning, is to help people create wealth for themselves down the road. Am I a financial advisor, a licensed financial advisor? No. But what I do is I do share your information with advisors if you don't have one, or work with your advisor to help you get to a financial position in life where you feel comfortable. I think we would all agree that getting to retirement some fine day for us all would be nice, and it would also be nice to have it in such a way that we don't have to necessarily have to worry about money, but to be able to live comfortably. Those decisions we make today will determine how comfortable we are in retirement. So one of the things we want to take a look at, as we talked about right now, is the debt level. With inflation, a lot of people have gone out and increased their credit card debt to just stay above water with respect to keeping up with inflation and the high cost of food and gas, as we spoke about before. One of those things you can do to correct that is to get a loan consolidation loan to consolidate your debt. That is one way to be able to do it. Your credit union, your bank, whatever the case might be, to be able to consolidate your debt. Another way is if you're a homeowner, we've all seen as homeowners an increase in the appreciation of our homes. We all have an awful lot of equity. If you are a homeowner, taking a look at a home equity line of credit to be able to consolidate that debt and have a more affordable payment to get you through this inflationary period a little bit better. The other way, and the other reason other possibility is prioritizing how you pay off your debts. If you're fortunate enough to pay a little extra on all your debts, that's really not what you want to do, because it's going to take you longer to pay off your debts. What you want to definitely do is take whatever extra. For example, let's say you're paying an extra $100 or let's say $200 a month on your debts. What you want to do is focus that $200 on your smallest debt. Most people will say, focus it on the highest interest rate. Well, what happens is that is not bad advice, but what the psychological part is what I believe in the most as we go ahead and consolidate that, and that is to go ahead and work on the little ones first. And the reason being is once you get it paid off, it kind of feels good, right? You got that debt paid off, it's not hanging over your head anymore. So you just take the money that you use to pay off that debt, that $200, and maybe add a minimum payment of $50 a month. And you combine that and take that $250 to the next lowest debt that you have to continue to pay that off, and then combine that payment. So it just kind of snowballs until you get to your highest debt, where you see a large sum of money every month going towards reducing that and saving the interest on that. So if you don't want or feel you could do it on your own and not worry about a consolidation loan, that's fine. Or a home equity loan, that's fine. I'm happy to work with you and help you out with that too. A lot of things, what we're seeing today is a lot of people are being affected by their credit. When they go out to apply for an auto loan, or a home equity loan or a mortgage loan, their credit or insurance, their credit plays a huge part of that. And repairing your credit and getting your credit to a point where you are able to go ahead and find that your credit score is high enough so that you're not paying extra for those things can save you thousands of dollars. We know the interest rates on car loans, for example, have gone up. But if you have good credit, that rate isn't going to go up as much as if you didn't have good credit. And so we work with people also from a credit repair standpoint to help them increase their credit scores over time and to get them back on track so they're not paying more than they have to for their credit. The other thing is a lot of people do budget, but mostly a lot of people don't budget. They live month to month. One easy way to help you with that is to just take a list of who you owe every month, whether it's your utility bills, to your car loans, to your mortgage, to your student debts, to your credit cards. Take all those things and list them out during the course of a month. One of the things you might want to do, and it's a great exercise if you have kids at home that are close to teenage age, is to put your debts on a piece of paper, not include the amounts, but share that with your kids and have them say, okay, what do you think we pay for a mortgage payment? Or what do we pay for a car payment? We did that a long time ago with our kids, and it was amazing. They were pretty close on a lot of things, but a lot of things they were way off. But at the end, the conversation was, it's for them to understand the value of a dollar and how much things cost. But that's a good lesson for us all too, as adults, is to be able to go ahead and look at that on a piece of paper. We get so caught up in how busy we are during the course of the day that the days fly by and we don't take time to look and say, where is our money going, by the way? So it's a good idea to go ahead and do that. Whether you want to share it with your kids is up to you. I have budget forms that I can share with you if you want to go ahead and have me email one to you. I'm happy to do that, but we can go ahead and help you with that and sit down with you with that too. The other thing that it's important to have, so we're not depending on the high interest rate credit cards, is how we create emergency funds for ourselves. You know, we all have had in the past a car repair that comes up, or a medical bill that comes up, or another unusual expense. And we find that many times that the first thing we reach for is a credit card for that, to go ahead and use that. And yes, credit cards should be for emergencies, and that's fine, but many times it's not. And it's nice to have an emergency savings account. The rule of thumb for most financial planners for emergency savings account is taking 3 to 6 months of your net pay and having that in a savings account. Okay, and working towards that. So when an emergency comes along, you're able to pay cash for that, as opposed to putting it on a credit card with the high interest rate and paying that over time to help you out. So it's very important that we take a look at where we are as a household and what we have to owe, what we are owing on our debts right now. So I would ask that, you know, you take a bit of time and sit down with your spouse if you're married, and just say, okay, let's just take 30 minutes, write down what we have as far as debts, and to see what we can do about that. Many times, many times, and I have counseled with clients, and you never realize how much people eat out. When I look at bank statements and credit card statements, Rachel's smiling there. When I look at bank statements and credit card statements, it's amazing the amount of money that goes to fast food restaurants, or, you know, non-fast food restaurants, or just eating out. And being able to cut that back 25%, 50% or more gives you that extra cash flow to help you out and going ahead and paying down on some other debts. So it's making more meals at home. It's taking leftovers to work. You know, it's things like that that are important to help you cut corners until you're able to create a cash flow that's comfortable for you and look to your future. Many times I was guilty of it. You know, when we were younger, we looked at, okay, Rachel said $4 school lunch. Okay. That's good. That's good. That's better than, you know, $12 at McDonald's. But the important thing is to just evaluate where you're at right now, and meet with somebody that can sit down and help you out with this and get you on a path. Most of it is it's very simple. It's easy for me to say, but it all comes down to financial discipline. It really and truly does. But if you have somebody like myself as a coach, and you set up a plan that somebody's going to call you now and again to remind you, okay, where are you on paying down those debts? Have you saved this much money per month? It's important to just kind of have that little extra push to help you out. And so I know I'm getting close to my time, but does anybody have any questions that they'd like to share? And I'd be happy to answer them. You don't have to necessarily tell me your personal story, but if you're talking about things in general, I'm happy to address them. Quiet group. Rachel, do you have any questions?
Gosh, I think you covered a really nice range of different things there. Trying to think.
There's a lot more we can get into. And obviously we can't on a 15-minute Zoom call. But
Right.
I want to give you all, if you have a pen and paper handy, my cell phone, as well as my email address, to reach out to me. I'm happy to help you out. And it is no cost at all to this. There really isn't. It's a service I want to provide to you folks as employees of the district. I'm very involved with the district myself. I'm the chair of the Community Council on Education. So I value the district and what they're doing, and anything I can do to help out the district employees, I'm happy to do so. So you can reach me at 970-381-4374. And my email address is Steve, STEVE LaForest, so it's LA and then Forest, FOREST at N as in Nancy, A as in Apple, F as in Frank, Inc. INC.com. Somebody just had a question there. I missed that, Rachel.
So there's a couple questions. One of them, is there a certain percentage of your income that you recommend putting into savings?
You know, if you talk to a lot of people, they will say about 15 to 20%. All right. That is not possible for a lot of people to be able to do that. The thing is, if you can't do that right now, then it's what can you do to get to a point where you can? Many times it's paying off debt. All right, but that would be the ultimate goal you would strive for.
The next question, do you suggest a budgeting app? We used Mint, but now it is no longer, I'm guessing they just forgot the word free. I'm not sure.
Yeah, absolutely. Absolutely. Those can be very, very helpful. And then what it does is it walks you through what I just said, is making a list of your debts and taking a look at things and how you budget based upon your net income and all that. When I counsel people for a mortgage loan, many people don't realize that, they say, well, you qualify me off my net pay, right? And I said, no, we qualify you off your gross pay. And so you pay your bills off your net pay, right? So it's important to know what your budget is, and those types of apps are very, very important in helping you out with that. Good question.
All right. The next question, would you suggest paying off a low interest mortgage or investing?
Investing. Okay. Right now, there's a lot of people out there that have low interest rate mortgages that would like to move, for example, but are not moving because of the low interest rate. If you have a low interest rate, definitely, because your investments are going to give you, depending upon your rate, if it's anywhere from 2.5% to 4%, or maybe even a little higher, my recommendation would be to invest that money.
All right.
If you have a spouse that is working that isn't on PARA, then max out that 401k first.
The final question I see in here is, do you agree and follow Dave Ramsey? Ideas sound similar. I love his book.
Dave Ramsey is a great person promoting wealth, and teaching people how to do it. There's one thing I don't agree with Dave Ramsey on, but everything else, his book is great and he has great advice. And that's because I'm in the mortgage business, but he says pay cash for a home. Well, who can pay cash for a home these days? That's what he wants. Or if he says you have to take out a mortgage, take out a 15-year mortgage. It's not possible. With the high price of interest rates and the high price of homes, I mean, less than 1% of people could even do that, of the people that could afford to buy a home. So, but he's great as far as what to do with other things in your financial life, without question.
All right. There was a couple of comments put in there about someone mentioned they like the Every Dollar app. they've been using that. And then I said I like to use Credit Karma mostly for making sure no one is trying to use my credit. Making sure there's no credit reports in there that shouldn't be, or credit requests.
Those are Credit Karma, and some of the other services are great. But just keep in mind that use them just as a barometer of your credit score. Because when we do a tri-merge report, for example, when we're doing a mortgage loan, the score you get on Credit Karma does not match the score we get. And many times it's a little bit higher. But I think Credit Karma is great to use as a barometer to see if, for instance, if you're paying down debts or paying off debts, is your credit score going up?